The developing world is bracing for a very tricky 2025. Emerging market nations have to deal with the added stress of paying interest on the $29 trillion in debt that was accumulated over the past decade. The United Nations reports that a record 54 nations will pay interest that exceeds 10% of their earnings. Some countries like Nigeria and Pakistan will pay more than 30% of their revenues on coupon payments alone. As a result, nations are cutting down on internal investments like roads, schools and hospitals. This increased risk for investors in developing markets, totaling around $850 billion in debt last year. Well, Roberto Safon-Aravalo, global head of sovereign ratings at S&P Global Ratings, said interest burdens are massive. There's a lot of muddle through, but there's a tremendous amount of risk. The debt risk is something that the developing markets have to worry about in 2025. In addition, uncertainty about the Chinese economy, rising geopolitical tensions, and the effects of Donald Trump on U.S. rates and dollar forecasts all point to a rocky 2025. Morgan Stanley's data shows that global investors are already pulling their money out of hard currency, with outflows exceeding $14 billion this year. Emerging market debt over the previous decade has more than doubled to about $29 billion. As a result, they have large interest payments and bond maturities that must be met or refinanced. In the next 2 years, approximately $190 billion in foreign bond obligations are due. EM debt investors were hit hard by a string of defaults during the pandemic. The prospect of an additional wave of failures highlight further risks.